All right, let's dive right into this explainer. Today we're looking at one of the most vividly named and honestly one of the most closely watched signals in all of technical analysis, the hanging man. We're going to strip away the noise, look at the cold hard data, and learn how to decode market psychology so you can spot a trend reversal right before it happens.
So you gotta ask yourself, how do you actually spot a market top right before the whole trend just collapses? I mean, we've all been there, right? You're riding this beautiful green uptrend, everything is looking fantastic, and then bam, the bottom just completely falls out. But what if the market usually leaves a footprint right before that collapse? A specific shadow that tells you the bulls are totally losing their grip. Section 1. The anatomy of a hanging man. Now, context is literally everything with this pattern. It doesn't just show up randomly. If you see this exact same shape at the bottom of a downtrend, it's actually called a hammer, and that signals the exact opposite. A true hanging man has to live right at the absolute peak of an established uptrend. It's basically waving a massive red flag that the buyers are exhausted. Think of the candlestick like a physical figure dangling at the top of your chart. First off, you're looking for a small body sitting right at the very top of the trading range. Below that body, you need a long lower shadow. And when I say long, I mean it's got to be at least twice the size of the physical body itself. Finally, there should be little to absolutely no upper shadow. Okay, so body color definitely matters here. While both are technically valid, a red body packs a much more aggressive warning. A green body basically means the buyers still managed to close the session slightly higher than the open, despite all the intraday chaos. But a red body, that means the sellers actually forced the closing price below the open. The bears are grabbing the steering wheel, and the alarm bell is ringing a whole lot louder. To really train your eye, let's contrast it quickly with a shooting star, which is essentially an upside-down hanging man. A shooting star's long upper shadow tells us buyers tried to push up but got completely swatted down. The hanging man, conversely, shows sellers pushed the price way down early on, and even though the buyers recovered it, a deep vulnerability is now exposed on the chart. Section 2. The psychology of the shadow. You know, behind every single candlestick is this incredibly intense psychological tug-of-war between fear and greed. Think about what that long lower shadow actually represents in real time. It represents a sudden, almost violent influx of sellers just dumping the asset. Sure, the bulls might have pulled the rope back to the middle by the end of the day, but that massive mid-session slip shows everyone that the bears have arrived in full force. So even if the bulls technically recover the price by the closing bell, that massive sell-off proves the trend's foundation is totally cracking. It's kind of like a building surviving a major earthquake, right? I mean, yes, it's still standing when the day ends, but the structural integrity is completely compromised. The buyers are exhausted from the effort of fighting back that drop, which makes them super vulnerable to the next attack. Section 3. Executing the trade strategy. Spotting the pattern is honestly only half the battle. The absolute golden rule of candlestick trading is this: never, ever execute a trade on a single line without solid confirmation. So many eager traders just jump the gun the second they see that hanging man shape, only to watch the uptrend happily resume the very next day. That is a painful false signal, folks. Patience is your ultimate risk management tool here. Let's walk through the exact steps to separate a profitable short from a total disaster. First, confirm the uptrend. Second, spot the hanging man. Third, and this is completely non-negotiable, you have to wait for the very next candle to close bearish. Ideally, you want a nice red candle closing below the body of our hanging man. Only then do you enter short. And to protect yourself, you just tuck a stop-loss order right above the high of the hanging man. If the price breaks above that, the reversal failed, and you're out safely. Now, the pros limit their exposure by stacking technical advantages, what we call confluence in the business. If you see a hanging man forming right at a major historical resistance line and your RSI indicator is screaming that the asset is overbought, well, now you're really stacking the odds in your favor. And since this specific pattern doesn't hand you a take-profit target, you always want to look left on your chart to find the next major support level to plan your exit. Section 4. Data-driven reality checks. We aren't just relying on old chart folklore here. We have the actual algorithmic data. Between 2010 and 2015, the hanging man only showed up 3.55% of the time among all candlestick patterns in the S&P 500. It is a rare, critical event. It absolutely doesn't happen every day, so when it does flash across your screen, it demands your attention as a real statistical outlier. And look, this data proves exactly why waiting for that bearish confirmation candle is mandatory. Almost 13% of these patterns end up being complete false signals. But look at the top of the chart. When tested over a 10 candlestick period, it resulted in a high efficiency bearish drop over 40% of the time. It is highly effective as long as you don't fall into the trap of trading it unconfirmed. Also, pattern efficiency varies wildly depending on the specific asset you're trading. For instance, stocks like Vertex Pharmaceuticals showed massive high efficiency hit rates. We're talking over an 86% success margin. Xilinx and Alcoa also showed incredible reliability. This proves that understanding the historical personality of the asset you're looking at is just as vital as knowing the pattern itself. When weighing it all out, the real beauty of the hanging man lies in its simplicity. Plus, it gives you a crystal clear line in the sand for a stop loss. But the downside? That relies entirely on human psychology. If you lack the patience to wait for that bearish confirmation candle, or you fail to map out your own take-profit targets, the pattern just isn't going to save you. So the next time you're staring at an uptrend that looks virtually unstoppable, you now know exactly what kind of shadow might be creeping up from the bottom. You have the tools to spot the exhaustion, the patience to wait for that crucial bearish confirmation candle, and the discipline to manage your risk. The market is constantly trying to tell you a story. The real question is, are you disciplined enough to listen? Keep your eyes on those charts, and whatever you do, never trade the shadow without waiting for the fall.